Everything that I have learned in the last 14 years of being a trader about trends and how to find the best trades within trends is packed in today's video. And I've prepared some really special chart studies, tips and tricks about how to better understand charts and trends in this video. And here on the left side, you will see a very basic outline of what we're going to cover today. There are also timestamps in the video description below if you want to jump to a specific chapter. However, if you're watching this for the first time, I would just recommend watch it once at first and then jump to the specific sections that you would like to revisit. And first, we will start with Trend Theory Part 1 and the basic introduction. We will then move into Trend Theory Part 2, which is a little bit more advanced. Then we will progress to pattern secrets and how trends and waves connect to patterns and how to trade them. We're going to also then look at trend trading tools and what are the best trend trading tools. We're going to take a look at wave cycles, Elliott wave dynamics, and a few other very important concepts. And then at the end, I prepared a few very, very special charts for you where we're going to cover trend wave strategies and how to find the best trades within trends. All right, so let's get into the charts. And as I said, we're going to start at the foundation, but just within a few slides, we are already going to be at something a little bit more advanced. But I would really like to start at the foundation because if there are new traders watching, I don't want to feel them completely lost. So give me 1 minute. And when we look at a chart, we are usually talking about macro trends and micro trends. Macro trends are, so to speak, higher time frame trends. And we would like to always know the trending environment the market is currently in. Is the market in a currently uptrending market? Is the market currently downtrending? Or is the market maybe turning sideways? Or is the market currently topping out? And I have a few tips later on how to use different tools and concepts on how to analyze a higher time frame in that regards. However, in the beginning, it's just very important that we first understand that there can be trends, and even more important that the market is not always moving in one straight line. Just because the market is in a higher time frame uptrend, it doesn't mean that the market is just moving in one straight line. And there's always going to be this up and down in some traders, and we will call that actually later waves. And when we look at a trending market, so assuming that we are in a higher time frame uptrend, you will see that those trends on a higher time frame are made up of smaller time frame trends. And there we are talking about impulsive and corrective trend waves. Impulsive trend waves are trend waves into the higher time frame direction. So in a higher time frame uptrend, the impulsive waves go up, and then we have the corrective waves that are going against the higher time frame direction. And this is a constant interplay between impulsive and corrective waves. And we're going to cover something really interesting later on how we can use the relationship, the size, and compare impulsive and corrective waves to find better trades and to really understand and look behind the scenes what is going on between the buyers and the sellers. A second point is that when we look at a trending market, we can usually distinguish between different trend stages. And also when we take a look later at Elliott wave theory, this will become crystal clear and very helpful. So very early on, when the market turns from a downtrend to an uptrend, we are talking about an early trend or a new trend. And once this new trend and early trend is progressing a little bit, we are entering the established trend phase. And then at the end of a trend, after the trend has been going on for a while, we are entering the mature trending stage. This is where trends sometimes top out or even completely reverse. And understanding this is very important later on because dependent on which trend stage you're currently in, this is going to change the trading style that you want to look for. For example, in an early and a new trend, what you generally want to do is look for breakouts. They are very profitable because at the early trend stage, the market still moves quite a bit. Once the early trend stage and the new trend stage is over, we are entering in an established trend, and here you want to be a little bit more patient, and here you would like to preferably look for pullbacks. And then finally, at a mature trend stage, when it's very obvious that the market has been trending for a while, you want to start looking for trend reversals into the opposite direction. So then you can connect here often the mature trend when it leads to an early trend. There is when things get very interesting later on. And as a trend trader, there are a few things that we need to answer and that we have to answer. First, will a trend continue? This is obviously a very, very special and very important question because it's going to determine if we want to trade or not. Then also we want to understand if a trend is likely to pause or even reverse. because it means, are we going to go with the trend or are we going to even go against the trend? Something really important about the dynamic between the buyers and the losers is the question that we will answer: is the trend gaining strength or is it losing strength? If the trend is gaining strength, we generally want to go with the flow. So here we are generally looking with breakouts. Is it losing strength? Then we may want to take exits if we are already in a position, or even start looking for trading opportunities into the opposite side. And something also very interesting, is a pullback turning into a continuation or not? This means more specifically, a pullback is often referred to as also in a corrective waves, and sometimes, especially in a mature trending environment, those corrective waves will keep going and going and going and not always turn around into an impulsive wave. And sometimes the corrective waves will actually become impulsive waves into the other trend direction. So when we go from an overall uptrend to an overall downtrend, this is usually done when the correction waves extend and lead into impulsive waves. And obviously the question, is it a good time to enter a trade, is something that every trader needs to answer before pulling the trigger. Alright, so let's slowly start looking at charts, and then we will get into the more advanced concepts and the trading strategies that I've prepared in a moment. So when we just look at this chart, we are looking at a very healthy uptrend, right? Everything looks good, the market is rising and everything is fine. And sometimes even, especially in the beginning, if you have problems, I would always recommend to switch periodically to a line graph, because it may provide a clearer picture. And especially the concept of the Dow theory is very important. The Dow theory, among other things, state that the market is in an uptrend if the price keeps making higher highs and higher lows. And what you can see here when we look at the line graph and we just put our dotted lines on the lows, you will see that without a fail, the market did make higher highs and higher lows here. So we are in an uptrend. And now we are moving a little bit further and we are progressing here and we're following the price action. And now suddenly, where in the beginning we have looked at the first part of this trend, now things look very differently. And why they do look differently? First, when we look at only the highs need much longer to push higher. And you can see from here to here and from here to here and then finally from here to here, the price took quite a long time to move higher. And just compared to what has happened previously, the market was able to move higher easily in a short matter of time and also much steeper. This is our first indication that something is changing and we are going from an early trend to a more established trend that moves much slower. But there's even more. And second point that is changing is that the corrective waves are now much deeper. And this is even more important than looking at the highs, because looking at the correction waves, you can see a very different picture. Here the correction wave, very long and very deep. Very long and deep, long and deep. And compared to what has happened here in the first part, yes, the market did have correction waves as well, but they were short-lived and they were not as deep. And what this tells you, there are two things that this tells you. First of all, there are probably a lot more sellers in the market who are interested because the price is suddenly at a higher level and it's become so high that it's attractive for the sellers to sell. And everyone that has bought previously and that is in a long position is now more inclined to start selling because they are sitting on a huge pile of profits. And by exiting their profitable trades and their buying trades, they're also going to contribute to this downward pressure. So this is very important because this suddenly paints a very different picture. And obviously we're just getting started in this video, but you can already see that those little clues are going to help us later on to find very profitable trading opportunities. And now let's move this chart a little bit further and see what has happened. You can see the market afterwards, after making higher highs and higher lows, turned around and made lower lows and lower highs. So it completely turned the Dow theory around and the market went from an uptrend to a downtrend. And so now let's follow the price action here on the right side. On the right side, this is something that we can very often observe. Initially, it takes a little bit of time. When we talk about advanced concepts, this is called accumulation and distribution. I will make a separate video on that later, but for now, What you need to know is only that it does take some time to get a trend on its way. It's like a big train that is going from one direction and turning around into the other direction. It usually cannot just turn around on a dime and start a new trend. And especially in this case, we're looking at the euro US dollar, which is the most traded Forex pair with a lot of trading volume. And this is going to take a lot of money and a lot of power to turn the euro US dollar around and start a new trend. So in the initial phase, it may take a little bit time. There's a lot of ranging going on, but once the initial hurdle has overcome, this is where really you can see the trend pick up a lot of speed. And this is what we'll see in the initial early trending phase. That's why I said in the beginning, and I will come back to that, early on, you want to look at new trends, and the ideal strategy for new trend are breakout trades. So let's move here a little bit forward and see what has happened afterwards. Now, first of all, we are looking at a healthy downtrend. And then again, things are changing. And whereas in the previous time, in a short period of time, when we look from here to here, for example, the market in a short period of time made a huge move to the downside. Here, when we just compare it from here to here, in a much longer period of time, the market obviously didn't move as much, just a little bit lower. And this tells you that this is not a very strong downtrending market. There are not a lot of sellers, and probably many people who already sold are slowly unwinding their positions, maybe even going into the opposite direction here when the market has become more attractive to buy again. And then when we move forward, you can see that this downtrend then slowly is turning around and starting an uptrend. So although we're just getting started, you can already slowly start to get an idea for the different trend stages, the different trend speeds, how things are turning around, what is the interaction and the connection between impulsive and corrective waves. So now you will see the power of it once we move into the other chapters. So now we're going to take a look at one of my favorite topics in trading, and this is chart patterns. And we're going to see and connect what we have learned to chart patterns. And waves are the building blocks for patterns. And this is going to be a revelation for many people and something that not many have considered before. So let me just start with a general head and shoulders. We can just look at the very abstract way of looking at a head and shoulders and the way a head and shoulders forms. And a head and shoulders is usually found in a mature trend. So generally what you want to look for, you don't want to look for a head and shoulders in an established trend, definitely not in an early trend, but you want to look at a mature trend. And keep in mind, I will show you a few tips and tricks on how to actually distinguish between the different trend phases in a moment. But head and shoulders are generally looked for in a mature trending environment. And what this tells you then is that the market is an uptrend, we're making higher highs and higher lows, but once the right shoulder is formed, we know that the market is making a lower high. And also usually we call this here the neckline. When we connect the two lows here on the head and shoulder, this is the neckline. And once the neckline is formed, you will see that the neckline is at the same level usually. And this means that this corrective wave from the head to the right shoulder is very deep. And whereas previously you can see the corrective waves are very shallow, this is a completely different picture. We have a large correction wave and a very small impulsive wave in the uptrend. And then especially once the market breaks here below the neckline, this is where you are not only making lower highs, now you're also making lower lows. So head and shoulders is very nicely showing you a trend shift. And when we look at a wedge, also the ideal way to look for a wedge is in a mature trend, because that is a trend reversal. So a very important piece to the puzzle is that if you are looking at any trading strategy or any trading pattern, you always want to look and ask yourself, what is the trading strategy actually trying to do? Is it looking for continuations? Is it looking for reversals? And then you can really understand when you should be trading a specific strategy. And this is something that many traders do wrong. They want to be trend reversal traders or pattern traders, but then they look for them in an early trend, or they want to be continuation traders, but they are very late and they try to trade it in a mature trend. And this leads to a lot of problems. So when we look at a wedge, what is a wedge made out of? A wedge is happening in an uptrend, ideally in a mature trend. That's where you want to look for wedges. And a wedge is then showing you smaller trending waves, and the market is slowly narrowing down and coming down into the end of a wedge. And you can see previously the market usually does larger impulsive waves, smaller corrective waves. Suddenly this ratio changes and the impulsive waves get smaller, and also the corrective waves then get smaller and smaller until the market is here ending into the upper limit of the wedge. And that is usually where you then start to look for breakouts into the new trend direction. Because what does it tell you? It tells you that the uptrend, although it's continuing, the market is making higher lows, it is not very convincing, and it's probably time to look for a new trend and a new breakout. Or if you are in a long trend, then that's where you want to start looking for exits, because this is not a high probability pattern that is showing you the market is likely to keep going higher. So if you're in a long position, that's where you want to start unwinding here slowly. We're going to take a look at a double top. And what does a double top tell you? It tells you, very similar to a head and shoulders at first, that you have a very deep correction wave. Again, in an uptrend, correction waves are usually much shorter than impulsive waves, but here suddenly you'll see the double top is made up of a resistance at the top, a support at the bottom, and you can see the corrective wave is very long, and the impulsive wave is not able to go beyond the last high. Whereas previously all the impulsive waves are always able to break into new highs easily here. Now in a double top, this is where the price is struggling and the market is not able to push into a new high. So it's a very, very big heads up. The uptrend is not as strong. The buyers are not as strong anymore. There are probably a lot of people who are exiting their positions here if they are long. And the price has become so high that it's interesting for the sellers to get into slowly. And then you generally want to look for a breakout. And then you can obviously build your different trading strategies around it. Do you want to be a breakout trader and you trade the breakout out of such a pattern, or would you like to be a pullback trader? And I've prepared at the end, when we go into the last chapter about trading strategies, a few ideas and tips and chart studies on how to actually get into trades. So now we are going to slowly take a look at the best tools for trend and wave trading and how to really get into trades. But if you haven't watched the beginning and if you just skip to this time step, I would really recommend that you go back, watch it. It doesn't take a long time to get here, but it's very important that you also watch the beginning so that you know the different concepts and the terms that I'm going to throw around. So let's get into the charts. And the first thing, obviously, if we talk about trends, we need to talk about trend lines. And the name should give it away. Trend lines are used for trends. However, there are two different ways how trend lines are used, and I made trend line strategy videos in the past, but if you want to just know the very basics, the first way to use a trend line is to look for a continuation. So in an uptrend, you want to draw a trend line at the bottom. This is very important. A trend line at the top is not really helpful because what does it tell you? It doesn't tell you a lot. And you definitely don't want to go short in an uptrend. So the upper trend line is not super important. If the market is in an overall uptrend, you definitely want to draw your trend lines at the lows. And then the general idea is that you look and you wait for the market to get back to a trend line. So here's the beginning of a trend line. We have the second point here. Here's the third point. And this is then where people start looking for long entries. Because again, I mentioned it many times, a trend line is only valid if you have 3 points on the trend line. You can use a diagonal line and you can connect any two random price points. Doesn't matter. You can always connect any 2 points, but only if you have 3 points on the same diagonal trend line, then you're talking about a valid trend line. And you can then use that to find trading opportunities into the higher time frame direction, into the trend line direction. Sometimes trend lines change, and whereas you can see here in the beginning, the market had a moderate trend line, the trends seem to have accelerated later on, and then we have another trend line that you could also choose to trade. However, you can already see, I'm hinting it, something has changed here. Suddenly we have a very deep correction wave, which we have seen in the past, that's okay, but here we suddenly have a double top. And we've just learned about double tops. What do they tell you? Especially in a mature trend, that's the most important part. Where it's happening is very important. The context matters. The double top is happening after a long trending period. And that is showing you exhaustion. Probably a lot of people who have previously bought are not super keen on buying more, and they are more looking for exiting their trades to really secure the profits. So again, if you're using a trend line, what I would recommend, trade the first few touch points. But if you're seeing that you're going on to have 5, 6, or 7 touch points, this is first of all not very rare, not very common. But I would also be a little bit more cautious because you are entering the mature trending phase. The second way how to use a trend line is for reversals. So if you see that a trend line, an established trend line, has been broken, then a common trading strategy is to look for trades into the new direction. However, again, context matters. And where do you want to look for trend reversals? You want to look for trend reversals in mature trend lines. So after the trend line has been established for quite a while. And you also want to look for a trend line break and a trend line reversal after the market has been trending for a long time. Especially when we look at Forex, which is generally considered a mean reversion market, which means that the trends don't last as long as in stocks. You generally want to look for established trends. You want to look for trends that have been going on for a long time. And once those trends start then showing signs of weakness, this is where you start looking for trading opportunities into the new direction. A great way to help you understand the trading environment and the market environment that you're in is using moving averages. And we are here. Let me get that off. So we are on the 30-minute time frame, and I added a 60-minute moving average to the charts. This is the blue line here. And you can see we are breaking into a new trend direction here. The market is going from downtrend to uptrend. And then here the market has been trading on one side of the moving average for quite a while. So the longer the market is trending on one side of the moving average, the more likely it is that a trend is ending. And especially in Forex, which is a mean reverting market, trends don't last for a long time. And you want to look for a trend line. So we have 1, 2, 3 touch points. We have here a lower high. We have here a double bottom, which is important. The market suddenly made a huge corrective wave. And the impulsive wave here was suddenly not strong enough to get even close to the high. And then you can see the market rolled over. Now we're making lower lows and lower highs as well. Lower highs here, lower lows on the breakout through the trend line and through the previous lows. And then the market really rolled over. So you can see how we can nicely connect everything that we are starting to learn. Alright, so now let's take a look at a few more trend direction tools and a few ways how you can actually make sense of higher time frame and longer term trends. So the first one I would always recommend start with a higher time frame moving average and trade into the direction of the higher time frame moving average. That way the moving average really becomes a filter for you. For example, we are here on the 15-minute and I applied a 60-minute moving average to the charts. And you can see the time frame here and the moving average really acts nicely to distinguish between long-term downtrends and long-term uptrends. And if you can find a market that has been trending on one side of the moving average, that is usually something that you should follow and that often provides great trading opportunities. You can either wait for a break and a retest of a moving average, and then you are usually trading in the new and early trend stage, or you can wait for the market to stay on one side of the moving average for a long time until it reaches the mature trending stage, and then look for trading opportunities into the new trend direction. I put together a little overview of higher time frame and lower time frame combinations, so you may pause the video, screenshot if you want, and if you're using the lower time frame on a 5-minute, for example, your higher time frame moving average could be, for example, the 30-minute. The 15-minute uses the 1 hour, and so on and so forth. The way you set this up in TradingView is actually quite simple. So we go here to indicators, and then you just type in moving average, and then here it comes up. You can either use EMA or MA, doesn't matter. And then it is added to your chart. First, it's a regular 9 period by default. What is TradingView doing? So here we see it. We can open it by clicking on the settings icon, and then we can go to inputs, indicator time frame. We can change it to the higher time frame. For example, we are on the 1 hour and we want to change it to the 4 hour. Great. We also want to make it a little bit more visible. So we go to style, change the color to maybe blue or whatever, change the thickness. And then here you have your higher time frame moving average. You can, for example, go to the 4 hour. Then you can change that to your input as your daily time frame, higher time frame. And then you have it on your charts. The next one, which I really would recommend, but there's a little caveat, is a long-term stochastic. So here I applied the 1413 period stochastic. We are on a 30-minute and I applied the 4-hour stochastic. And what you generally want to look for are trending markets, and trending markets are often indicated by the stochastic being an oversold or overbought. Popular belief is usually incorrect when it comes to the stochastic indicator, and many traders believe that just because the market is entered into an oversold, like here, it means the market will start to reverse. However, exactly the opposite is true. If the market is oversold, it means that you are looking at a very strong trending market. So here the market is oversold for a long time, you're looking at a very strong downtrend. The market here is overbought for a long time, you're looking at a very strong uptrend. And here you're looking at a very strong oversold market, very strong downtrend. So what do you generally want to do is, if you, for example, want to specialize into mature trending, then you want to make sure that you find a market that has been an overbought and or oversold for a very long time. Then you wait for the pattern to emerge, then you trade the breakout into the new direction. That would be, for example, a great way how you can find higher time frame trends. Or you can use the combination of a trend line and a moving average. Again, we are here on the 1 hour. I use a 4-hour period 50 moving average here. So it very nicely describes the trend. I'm also adding a trend line here, and the trend line really nicely describes the higher lows of the market. So we are clearly in an uptrend. Then the trend line suddenly changes. We have a steep trend line, and now the angle drops off of the trend line, which means the trend is losing strength. And you can also see it here. The highs are not able to move higher as easily. We have here a triple top even. So the highs are not able to continue pushing into new highs, which, as we have learned, is a very strong signal that at least the uptrend is over, and very likely the market is going to reverse here on the breakout to the downside. So you can see you have a few options here: trend lines, higher time frame moving averages, even stochastic, the MACD. There are many choices that you can make for identifying a higher time frame trend direction. So be creative with it, play around and find really what makes sense to you. And there's never one size fits all in trading, so really try around, see what do you prefer as your personal choice, and then get comfortable with it and practice your skills. So we're getting into trend trading strategies in a moment, but let's just briefly revisit wave theory, Elliott waves, and trend cycles. And I've talked about this already, but this is very important. It's one of the most important slides probably in this video. And you always want to know in which trending stage you are in, because it's going to determine the trading style and the trading signal that you're looking for. Early and in new trends, this is usually when the market moves a lot in a short period of time. So here it makes sense to look for breakouts. In an established trend, you can still trade breakouts, but you're also probably going to add more pullbacks to your repertoire. And when you go to the mature trending stage, this is definitely where you don't want to look for continuations. And this is where you want to start looking for signs of weaknesses and then look for trend reversals. And in my experience, this is something that many traders struggle with, because they want to be trend following traders and that they always hear the term "the trend is your friend." And most traders then have the problem, and what they do is that they wait until the trend is really showing its hand, the trend has been going on for a while, and then they try to trade into the trend direction. But this is usually already when the market is slowly getting in a mature trend, because you can only see a trend, a very obvious trend, once it has been going for a while. And this is probably then leading to a lot of problems where traders just get into trend following too late, when the market has already completed most of its trending potential. And now let's just briefly revisit Elliott wave theory. And Elliott wave theory, as everything, has some pros and some cons, but let me just show you what this is all about. And Elliott wave theory says that trends and macro trends, that is long-term trends, often reverse after 5 trend waves. And to get to those 5 trend waves, we both consider impulsive and corrective waves. So we count 1, 2, 3, 4, 5, and then Elliott wave theory suggests that such a trend is likely to be over and very often also reversed. However, obviously this means on average, sometimes trends will keep going, give you 7, give you 9, give you 11 trend waves. Sometimes trends will only go for 1, 2, 3 trend waves and then reverse. So this means on average. And it is not really advisable to follow it to the T. But where Elliott wave really comes in very handy is that you understand in which trend stage are you in and what is the trading signal that you're looking for. You definitely want to look for breakouts when you're in wave 1, 2, 3. You want to look for pullbacks in wave 2 and 3. You want to look for signs of weakness in wave 5. And you definitely don't want to look for breakouts or continuations when the market has already trended for quite a while. So now let's take a look at trend wave strategies, and I'm gonna share a few trading tips and ideas on how you can approach trend trading. First, I would like to consult the Fibonacci's and especially Fibonacci retracements. They are ideal for early trend trading. And the goal of a Fibonacci is usually to trade wave 3. So once the market has made wave 1, wave 2, the trend Fibonacci retracement is then trying to help you trade wave 3 with the extension. So this is a very, very powerful tool. A lot of algos, a lot of higher or automated trading strategies are using Fibonacci's, which is also probably contributing why they work extremely well. So when we look at a chart, we draw our Fibonacci here at the beginning, A, B, C. This is what we always want to look for, A, B, C. We draw our Fibonacci from point A to point B. We get the retracement at point C, and then we can find our target in point D. So a Fibonacci is amazing. Once we have established that a trend is going on, we can then try to find ways how we can trade this early trending phase. So we have point A, point B, which is here the early beginning of a new trend. The market is just breaking this higher time frame moving average. So we go from A to B. That's where we draw our Fibonacci. Point C, roughly at the 50% retracement level, which is good. It's a retest at the 50 period moving average as well, which is amazing, exactly what we want to know. And then you can see we have the extension levels at 138, 161 and to 200. And generally speaking, the further away your Fibonacci, the wider your target, the less likely it is to reach, because obviously if you set your target wider, the price is not always able to reach it, and also you will stay in your trades much longer. So you can see here the market reached the 138, made quite a big retracement to test the previous highs, then kept going to 161, made another retracement, and then later went on to 200. So if you're looking for a Fibonacci strategy, make sure that maybe you consider taking partial profits at the different Fibonacci levels and scale out of your position here. We can take a look at a different example, point A, point B, point C. So this is a very early approach. You are still trading technically here below the longer time frame moving average. However, you are usually waiting with the Fibonacci to break below or above, in this case, the higher 100 level. So you wait for the market to come above the moving average here, and then you look for the different Fibonacci extensions, 131, 138, 161, 200, and in this case we even went to 261 and above. However, this is not very likely, and it does take a long and a strong trend to really get to those bonus Fibonacci rounds. So usually you are much safer off to using and choosing one of the closer Fibonacci levels. We can also consult a RSI divergence because they are perfect for identifying mature trends. If you can see a divergence in a mature trend, that is often a sign that the market is slowing down. And when you look at a wedge, for example, in a mature trend, a wedge will almost always come with a divergence. You could also try to find only head and shoulders patterns with a divergence. They often come up as well, and they already indicate that the trend is slowing down. So a divergence, just to recap for those who don't know, you look for them in a trending market, and a divergence is a signal where the price action and the indicator here are doing different things. The price action is making lower lows here, indicated by connecting the lows, but the RSI is making higher lows. So it shows you that although on a price action side it looks like the market is continuing strong, this is not the case, and the market is here already losing strength. And again, you could use your Fibonacci, point A, point B, point C, and then choose your target here accordingly. Here we have a double divergence. So the market has been trending for a long time, at least 5 trend waves here below the moving average. And then you can see here as the trend matures, you can see that we have a divergence here, connecting the lows here. We have another divergence here, so we have a double divergence. And you can then see the market is breaking out here above the moving average. And when we lay a Fibonacci on top of it from point A to point B, we have our breakout level here to point C. And then we can start looking for trade targets, 138, 161, 200. And this is how you could start approaching your trades. Again, if Fibonacci alone is not probably going to be that significant, a moving average alone is not helpful enough, a divergence alone is not meaningful, but if you put everything together and if you put everything in the right chart context, where are you looking for those things? Are you looking for them in a mature trend? Are you looking for patterns in a mature trend? Are you looking for those pullbacks and breakouts early on in a new trend? That is really where things get interesting. And this is how you can really build your strong trading strategies. And I've been trading Forex for around 14 years, and we have a premium Forex mentoring group where we hold around 4, 5, 6 live webinars every single week where we go through the live markets. I share my trading strategies. You have access to all the trading courses, and you can interact with me. I mentor you, I review your trades. So if you're interested in that and really kickstart your trading career, make sure to check the link in the video description. Or do you prefer to work on your own? I have completed a bundle now. So you get 4 trading courses for the price of 1. It is a price action course, a supply and demand course. It's a multi-time frame trading strategy, and also a Forex for beginners courses. Then also make sure to check the link in the video description below, and you can get started right away. So I hope you enjoyed this video, and I hope you got something out of it. If you did, leave a comment below, leave a thumbs up. I will be back next Tuesday because I release those trading videos every Tuesday. I hope you enjoy it, and I hope to see you soon.